Ind AS 115, revenue from contract with customers. Ind AS 115 is applicable to company which is going to earn revenue, and it is applicable to contract with customers only. However, it is not applicable to following types of contracts. First one, Ind AS life. L, lease contracts. For lease contracts, Ind AS 116 is applicable. I, insurance contracts. For insurance contracts, Ind AS 104 is applicable. F, financial instruments and other contractual rights or obligations. For that, Ind AS 109, Ind AS 110, Ind AS 111, Ind AS 27, Ind AS 28 are applicable. E means exchanges. In case of non-monetary exchanges between two entities which are in the same line of business, the business is to facilitate sales to customers or potential customers. For this exchanges, non-monetary exchanges also, Ind AS 115 is not applicable. For example, there are two oil companies. They agree to exchange oils to fulfill demand from their customers. In such a case, Ind AS 115 is not applicable. So, Ind AS 115 is applicable to contract with customers only. Who is a customer? Customer is a party who has contracted to obtain goods or services from the entity. The goods or services are output of the entity's ordinary activities. The customer in turn pays a consideration. Who will not be called as a customer? A party who has contracted with the entity to participate in an activity or process in which the parties to the contract share in risks and benefits, rather than obtaining the output of the entity's ordinary activities. So if the customer shares the risks and benefits instead of the output, then he will not be called as a customer. For such transaction, Ind AS 115 is not applicable. Example of such transaction is developing an asset in a collaboration agreement or arrangement. For this, Ind AS 115 is not applicable. What is the core principle of Ind AS 115? To recognize the revenue in a manner that depicts the transfer of goods or services to the customer at an amount that reflects the consideration that the entity expects to be entitled in exchange for goods or services. So, first there will be a transfer of goods or services to the customer, and customer in turn pays the consideration in exchange for such goods or services. Then revenue shall be recognized as per Ind AS 115. Next. There is a 5-step model for recognizing the revenue. To achieve the above core principle, an entity shall apply the 5-step model. Step number 1, identify the contract with the customer. Step number 2, identify the performance obligation in the contract. Performance obligation means promises in the contract. Step number 3, determine the transaction price. Step number 4, allocate the transaction price determined in step number 3 to the performance obligations in the contract. This allocation will be done on the basis of standalone selling price, SSP. Step number 5, recognize revenue as and when the entity satisfies its performance obligation. So, we will discuss in detail about the 5 steps. Another step number 1, identifying the contract. There are some criteria or conditions for recognizing a contract. An accounting contract exists only when an arrangement with a customer meets all of the 5 conditions. That means contract will be recognized only when all of the 5 conditions are satisfied. First condition, parties have approved the contract and are committed to perform their contractual obligations. That means performance obligations. Second condition, the entity can identify each party's rights regarding the goods or services to be transferred. Third condition, the entity can identify the payment terms for the contracts or services to be transferred. Fourth condition, the contract has a commercial substance. Fifth condition, it is probable that the entity will collect substantially all of the considerations to which it expects to be entitled. If all the 5 conditions are satisfied, then contract will be recognized. First condition is parties have approved the contract and they are committed. Second, identification of parties' rights. Third, identification of payment terms. Fourth, the contract has commercial substance. That means there is some consideration in it. Last, it is probable that the consideration will be received. However, there is a situation where even though any of the conditions are not satisfied, the revenue will be recognized. The situation is the contract has been terminated or there are no remaining obligations. That means no performance obligations pending, and consideration received from the customer is non-refundable. In such a case, revenue will be recognized. So, to sum up, revenue will be recognized in two cases. When all the 5 conditions are satisfied, revenue will be recognized. And second situation is when contract has been terminated or there is no remaining obligations exist and consideration received from the customer is non-refundable. In such a case, revenue will be recognized. Next, contract term. Contract term means contract tenure or contract period. An entity shall apply this standard to the duration of the contract, that is, contractual period in which the parties have enforceable rights and obligations. Termination provisions. There will be some contracts which can be terminated by either parties, or it may only be terminated by one party. In such a case, an accounting contract does not exist if each party to a contract has a unilateral enforceable rights to terminate a wholly unperformed contract without paying a substantive termination penalty. It means, for example, initially the contract term is 3 years. There is a condition that after 1 year, any of the party can terminate the contract. In such a case, actual contractual term is equal to 1 year, not 3 years. Next, combining contracts. Here, 2 or more contracts may need to be accounted for a single contract if they are entered at or near same time with the same customer and if any of the following conditions are satisfied. First condition, the contracts are negotiated as a single package. Second, the amount of consideration paid in contract depends upon the price or performance of other contract, or the goods or services promised in the contract are a single performance obligation. If any of the conditions satisfied and the contract is done at same time and with the same customer, then it will be considered as single contract instead of 2 or more contracts. That means the contracts will be combined. First condition, same time, same customer, single package, amount of consideration depends upon other contract, or it is a single performance obligation. In such cases, it will be considered as single contract instead of 2 or more contracts. That means no contracts will be combined. Contracts will be combined in such a case. Next, contract modifications. Identifying a modification. A contract modification exists in 3 conditions if 3 conditions are met. All the 3 conditions must be satisfied in order to consider it as a contract modification. First one, there is a change in scope, price, or both. In a contract, that change of scope, price, or both is approved by entity and the customer, and the change is enforceable. If all the 3 conditions are satisfied, then the contract will be considered as modified, and the accounting will be done as for contract modification. Accounting for modification. Another first one, modification that constitutes separate contracts. It is treated as a separate contract if both the conditions are satisfied. First condition, it increases the scope by adding new goods or services that are distinct, and increase in contract price reflects the standalone selling price of the additional goods or services. Then it will be considered a separate contract. First condition is there are new goods or services. Second condition is price reflects standalone selling price. That means price does not depend upon the old ones. In such a case, it will be considered a separate contract and separate accounting need to be done. Next, modification that do not constitute separate contracts. If new goods or services are distinct from goods or services in original contract, but price is not the same standalone selling price. In such a case, accounting will be done for modification prospectively. That is, we need to terminate the old contract and create the new contract. Here, there are new goods or services which are different from the original contract. And the price is not the standalone selling price. That means price depends upon the original contract. In such a case, we need to do prospective accounting for this modification. That means we need to terminate the old contract and create the new contract. And remaining goods or services are not distinct and are part of a single performance obligation that is partially satisfied. In such a case, the modification need to be accounted based on cumulative catch-up basis. That is, we need to do retrospective accounting. A retrospective modification need to be done. Here in this case, the goods and services are same and are part of single performance obligation that are partially already satisfied. In such a case, in case of modification, we need to do cumulative catch-up basis accounting. That means a retrospective accounting. Next, step number 2. Identifying performance obligation. Performance obligation means promises. A performance obligation is a promise to transfer to the customer either a good or service or a bundle of goods or services that are distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer. At contract inception, that means starting of the contract, an entity shall assess the goods or services promised in a contract and shall identify performance obligations under each promise. What are distinct performance obligations? A goods or service that is promised to a customer is distinct if both the following conditions are met. Both the conditions need to be satisfied. There is a two-step model to identify which goods or services are distinct. Another step number 1, check whether goods or service is capable of being distinct. That means check whether customer can benefit from the individual goods or services on its own, or customer can use goods or services with other readily available resources. Another step number 2, check whether goods or services distinct in the context of the contract. That means check whether goods or services is not integrated with and highly dependent on, highly interrelated with, or significantly modifying or customizing other promised goods or services in the contract. That means goods or services should not be interrelated, interdependent, or which significantly modify or customize other promised goods or services. If both the conditions are satisfied, then goods or services will be treated as distinct. Next, we need to check, are there multiple promises of goods and services which are distinct? That means which are not substantially same and that do not have same pattern of transfer. If there are any multiple promises of goods and services which are distinct, then it will be considered as multiple performance obligations. If there are no multiple promises of goods and services, it will be considered as single performance obligation. Next, promise to transfer a series of distinct goods or services that are substantially the same and have the same pattern of transfer. An entity is required to treat that series as a single performance obligation. That is, it is not an optional. Example, cleaning services, transaction processing services, and delivering electricity to the customers. So, in case of series of distinct goods and services that are substantially the same and which have the same pattern of transfer, it will be considered a single performance obligation. Next, long-term arrangements. For example, there is a 3-year maintenance agreement. Whether it should be considered a single performance obligation or should it be broken into small periods like daily, monthly, yearly, it may be appropriate to treat a 3-year service contract as 3 separate 1-year performance obligations. That means first year separate performance obligation, second year separate performance obligation, third year separate performance obligation. If the contract can be renewed or cancelled by either party at the discrete points in time, that is, at the end of each service year. In long-term service agreements, when the consideration is fixed, the accounting generally will not change, regardless of whether a single performance obligation or multiple performance obligation. So, accounting will not change whether it is single performance obligation or multiple. So, it doesn't matter whether there are one performance obligation or multiple performance obligations.